is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us.
Thank you, everyone. We'll get out of here.
Thank you.
So you just want me to share my screen?
So now we have Ron, who's going to be doing a presentation on the best performing asset class in the world.
Everybody see the screen and see me fine?
We can. Yeah, we sure can.
Okay, great. Well, thank you so much for being here today. Again, I want to thank the other companies for their presentations and also for 10 Capital Network. And they've been such a great partner and doing a lot of very good things for venture-backed companies and also for emerging managers, such as ourselves at South Highland Ventures. So, okay, everybody, search funds, the best performing asset class in the world. It sounds a little dramatic, but it really is the case. And so it's a confluence of several things that are happening in the marketplace, but really it's a $10 trillion market opportunity that is it's a real opportunity, but there's a real solution for the succession challenge that we're having around the world, and that is a search fund. It's a 40-year-old model that came out of Stanford and Harvard, and it's becoming more and more interesting and prevalent because the market opportunity and the need for it is more than ever before. But first, a little bit more about South Highland Ventures. Again, we're a full-service private equity firm managing direct investments for family offices. And these are some of the things that you may be familiar with. Some of these logos. PosiGen, it's a very innovative residential solar company that EBITDA has grown 13 times since our initial investment in 2018, and the company is worth over $1 billion right now. Also with RES, it's another company that grew from zero to nearly 100 million in EBITDA right now. And so at South Highland Ventures, we're very familiar with company growth and what it takes to understand all the transitions that companies go through from startup, from idea, all the way through to mid-market and even public markets. South Highland Ventures, we believe entrepreneurs are the superheroes of our time, and we have a balance of experience as investors, but also operators and advisors. Have over 20 years of being a part of the growth and exit process with companies, again, from initial idea all the way through to low mid-market and public market exits. Have over 100 transactions under our belt with over 900 million of assets under management, not counting the family offices that we've worked with from time to time making direct investments. And one of the unique perspectives that we have is engineers with business backgrounds. And in particular, with this opportunity with search funds, my reason for doing this is my grandfather had a business, as you can see here, had our own service business that he lost due to succession. He had a couple dozen employees and actually worked for Richard Petty in his heyday. And my father was on the pit crew back in the 70s. And so he was very good at what he did and he loved it, but my dad wasn't interested in the business and he regretted it to the day he died. And so it's really what has pushed me to get an MBA and to serve others and to serve other companies and investors that are getting into this asset space. Some of the recent activities for South Highland Ventures, is obviously working with Novastone Capital Advisors, which is a preeminent search fund advisory group, and I'll talk more about that. They've deployed over 200 million in their search fund program, but also some familiar logos. We're based in San Antonio and have been working with angel investments and also university-based technologies throughout the last 5 or so years. So the problem, this is a very big problem, over $10 trillion worth in the United States and then Europe alone. And these are companies where you have people that have founded a company and have grown it to a point, but they don't have anybody to pick up the business, right? These are companies that are doing basically 250K in EBITDA, upwards to 15 million in EBITDA. And they're stable companies with very strong profit margins, but they just don't have the access to capital and talent to scale the business and also to feel confident to hand the baton over to them so that they can pick up the business and grow it. And it's estimated that over 5 million companies are in the US and the EU alone. So it's a massive, massive problem that just keeps getting larger and larger. So what does that actually translate into? It's $1 trillion a year, 2,700 companies per day, which leads to $2.7 billion worth of value every day of companies that are closing their doors because they don't have a real solution that is available to them to allow the business to continue. But it's also an opportunity for us. And this really rolls into what the search fund has done and what it can do. And so some people are more familiar with search than others, but basically it's a hybrid of an LBO acquisition model, LBO meaning leveraged buyout in private equity. And so this was created in the mid 1980s through Stanford and Harvard, specifically tailored to find a greenish, 20-ish old entrepreneur that has talent, but they don't have the capital or the experience, but they're coachable. And so the idea was to back them, give them some money so they don't get a job, but to back them and to have them enter a phase where they search, where they're actually paid to go find a company that fits their investment thesis that they can run and then eventually acquire and become the CEO of. So you have this first stage where investors pay them to go find a company to acquire. And then once they find it, they acquire the company and then they grow it. The acquisition, like I said, is partially funded by debt and also with equity. And so this is the traditional search fund model that's been around for 40 years and has generated returns of over 35% net IRR on average per Stanford University. The growth in search funds has been quite amazing, mostly due because Father Time is undefeated, and so the problems are becoming larger and larger, and also the word is getting out. Thankfully, executives are learning about search funds and the opportunities that they provide, and there's just a lot of intrinsic value, but also it pays extremely well. I mean, those returns are very compelling for investors, but also for the entrepreneurs themselves. And so what we see is searchers are getting 1.5 million per year. A lot of that is based off of the sale of the company, but they're in a position where they can revitalize a company and modernize a company and grow it and get value with that, but also with the exit potential and the earning potential. And also there's been over $2 billion invested in search funds to date. And so it's a pretty large market, but still early, but growing. And this is where we get to search funds are the highest producing asset class in the last 40 years. And that's not me saying that, that's Stanford University. And when you actually compare search funds as an asset class, it does extremely well. It's double private equity and venture capital net of fees. And so these are due to several factors, but it really, in essence, it's going into markets that are underserved and getting into companies that are smaller than traditional private equity. And they do require some heavy lifting. They need to be modernized, and you need to have the right kind of entrepreneurial talent to take those challenges on. And that's where the value comes in. And private equity firms and strategics are actually okay paying the premiums for these companies because they're more updated and up to speed on current best practices and so on and so forth. But really, at the end of the day, the biggest thing to take away from this slide is that search funds yield twice the returns in half the time, which is pretty compelling, in particular because you're not taking anywhere near the same kind of risk and have the volatility as you would in like a venture capital fund, for instance, where half of your investments can go bankrupt. So we're not shooting for 100x with these kinds of investments, but really to focus on 3x in 3 to 5 years all day long for the companies that are invested in with search funds. why do search funds work? I really like this slide because it really focuses on the balance that you have. I mean, it is a hybrid model where it has parts of venture and also parts of private equity in the same model. And it needs to be a hybrid because of the size of these companies. It's a unique situation where you have to be able to build as well as grow. And so you really need to have a proper balance between the sellers, the investors, and the searchers. The sellers love it because they get to pick their leader. They get to pick the next person that's going to take their company. If they sell to traditional private equity, they don't get that choice. The private equity firm finds the deal first, and then they install their executive and their executive team. But in this model, it's the other way around. And so they have influence. They can work with the entrepreneur to create the growth plan and to find a proper cultural fit for the entrepreneur. The entrepreneurs love it because they're in a situation where they can work with the seller and get into a company that is already up and running and growing, has a potential for growth, and also investors for the returns. And there's a lot more in particular with this, where there's a lot more symbiotic help with what we're doing. But with the investors, it's a syndicate of investors that traditionally invest in search. So it's not one investor that takes a majority of the investment. And so everybody is kind of forced to work together. And I think that's one of the key reasons as to why you see the results with these companies, but also the obviously translating into returns. There are different search fund models. One is a self-funded search. If I'm a single individual and I just want to buy a company and run it for myself, there's obviously a lot of autonomy involved with that. But typically, these are companies that are in the $250,000 to $1.5 million range, and using SBA loans in the U.S. in order to acquire these companies. So you have more debt, you have less investor involvement, and you're buying smaller companies, but you don't have to have a board, right? You have more autonomy, but you have less upside to these kinds of investments. You have a traditional search where you have a solo search or a partnered search where you're working with a group of individuals to go out and pool investors that are within your network, right? You're pooling people that can invest in the search entity and also in the acquisition. And last but not least, you have the sponsored search, which is private equity backed, and also some search accelerators. The private equity backed search, there are some well-established groups, but there aren't nearly enough in order to fund the opportunity, the $10 trillion opportunity. But it also gives the entrepreneur the opportunity to acquire a larger company and have more sophistication and scale in order to more aggressively grow the company. And as you can see, the trend is increasing capital intensity and more governance complexity, but also a greater return potential. Because the larger the company that you can buy, traditionally the larger opportunity that you have to grow the company. Novastone, that's a partner that I mentioned earlier in the presentation. They've been investing in search funds for like 15 to 20 years ago, and through their vision, they saw that this is a highly fragmented market and figured out a way to scale the search fund and to create it to be more of an asset class. Search funds have been kind of difficult to find and vet because they are so fragmented and different in quality. And so Novastone's goal was to create a program that owns the whole search fund process from start to finish so that we can achieve scale and efficiency and be that apex partner for entrepreneurs, investors, and sellers. And so far, deployed over 200 million in equity since inception and have over 40 team members and have launched 100 entrepreneurs, nearly 100 entrepreneurs since 2020. So how the process works with South Highland Ventures is NCA is the group that built this deal flow machine, right? Where we have nearly 100 searchers that have gone through our selection process, and they are finding the acquisitions. And once they get to a stage where they have an LOI, that's where the institutional investors get involved. and where we get involved to deploy capital into the acquisition stage. So NCA has created this process. It's taken them 7 years to do it. And South Island Ventures as a partner is helping to run the machine, right? We actually help pick the entrepreneurs into the program, and we're deploying capital into it. And so it's kind of like I'm working with a stacked deck, but I'm also able to pick the cards that are in that stacked deck so that we can focus on the entrepreneurs and opportunities that are of the highest quality. Our allocation, we are basically agnostic when you look at the sector, and we are globally oriented. We have companies in the United States and also in Europe. But the key thing is that we're not specifically focused on a particular industry. It's more so the situation that the company is in. And so companies that are, number one, struggling with succession, and also companies that are generally in the 2 million to 10 million EBITDA range, and companies that have that potential for growth, where they need to be modernized and they've been neglected by the markets, which allows us to get in at an attractive EBITDA multiple, which is typically 4 to 6x EBITDA. That's really where our focus is. And again, this is some of the investment criteria that I've already discussed. But we do lever. It's only 50% debt, which is extremely conservative with most groups, which insulates us more on flexibility of cash flow, but also interest rate fluctuations. A couple of the unique things that we've done with our program is to make it more streamlined and to save time, is that we only work with entrepreneurs that have 20 years of experience in a specific industry. So we're not working with the green MBA students that are in their 20s. Folks that are in the middle of their careers and that have that industry experience and that have already been through a growth cycle with the company. Many of them have grown and sold a company already. And so what that does is it dramatically decreases the volatility of the performance of our companies, but also saves a tremendous amount of time, because usually an entrepreneur needs to like a year to a year and a half to get their feet under them, to really learn and understand the business. And the sellers need to kind of babysit them a little bit to make sure that they're taking care of their baby, right? Their life's work. But with our entrepreneurs, they hit the ground running. They only need like about a month or two to really get a handle on the company. And we're able to achieve results much faster. Also allows us to create exclusive deal flow for companies that aren't on the market. And in many cases, our entrepreneurs are bringing deals to us as we vet them. And that's really one of the key things. Another thing that makes us different, makes us special, is we don't have to lock up a company to buy more time to go raise money for the acquisition. Once we put a term sheet down on a company, we already have the commitments of capital to be able to close. And that gives the seller a lot of confidence in our ability and our sophistication and depth of capital. And so a vast majority of the time, we're working with off-market deal flow, exclusive deal flow. And also, we're not the highest bidder if there are other people that are involved, because it's kind of like a bird in the hand versus two in the bush kind of situation. And people respect our depth of capital and our experience with our entrepreneurs and with our group. Look at some of the numbers. We screen over 4,000, really we say qualified applicants annually, but it's over 4,000 applicants a year. It's a 2 to 3 month process per cohort, and about 1% make it through. So we're extremely selective in how we pick these executives into our program. We've launched nearly 100 searchers so far, to the point that we're acquiring 4 to 5 companies a quarter. So we're acquiring around 20 companies a year. And so this allows investors to deploy capital twice as fast as a traditional fund would, because all of that upfront work has been done to pre-screen the deal flow. And so we don't have to spend that time looking for the deal flow, because it's already been created for us. Again, working with that stacked deck. We've acquired 23 companies, deployed 200 million in equity, and have 7 LOIs that are currently active. So we have a bench of opportunities that are available. So for more information, here are some websites, and we'll make this presentation available for folks. But I just wanted to make sure that there are some more places where you can go to learn more about search funds and what we're doing, in particular, some great podcasts too. But in summary, succession is a global opportunity impacting $1 trillion a year of enterprise value. The search funds are a proven solution for succession, and South Island Ventures and Novastone have come up with an innovative way where we're taking the search fund model and modernized it for scale to the point where we have generated cash returns of nearly 50% IRR, and our portfolio is tracking at nearly 100% IRR. And more than happy to answer questions if people have them. Thank you so much.
Awesome. Thank you so much for that, Ron. Great
Yeah, no
presentation.
problem.
Do we have any questions from the audience members at this time? We have one from Pedro. Does SHV consider investments from different transactions?
Yes, we're an independent fund. We have a partnership with Novastone, and we do have the flexibility to invest in deals that are outside of the program, because I don't want to have blinders on. I want to be able to see what's going on and around the world, and to be a part of that. And so we do have that flexibility. But the key thing is to because of the high quality and the time and the diligence that has been spent on the entrepreneurs and their investment opportunities, that's where we really get to scale. But I didn't want to be chained to only have one place for deal flow. So we do have that flexibility.
Okay, thank you so much for that. There's a follow-up question. How can we reach you to share an investment memo?
Yeah, sure. I think my contact information is still showing on the screen, and that's my cell phone number and my email. We're also having a call actually this Thursday morning at 9:30, where one of our portfolio companies in the program is presenting, and it's actually for an acquisition in Texas. And so if you're interested in that, I can, if you send me an email, I can follow up with you, but also send you an invitation to that presentation also.
Yeah, and another thing is I am going to be opening up our breakout rooms here. So if you want to go ahead and talk to Ron in the breakout room, feel free to. I'm going to go ahead and do that now. Our breakout rooms will be open until about 2:15, and then I will be closing the webinar. So please keep that in mind. Okay, I'm going to go ahead and open all the rooms here.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halty Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.